Welcome to the Contrarian Investor Podcast. We give voice to those who challenge a prevailing sentiment in global financial markets. This podcast is for informational purposes only. Nothing on this podcast should be taken as investment advice. Guests were not compensated for their appearance, nor do they supply payment in order to appear. Individuals on this podcast may hold positions in the securities that are discussed. Listeners are urged to educate themselves and make their own decisions. This podcast episode may have ads and the occasional announcement. To listen without ads or announcements and take advantage of a host of other benefits, consider becoming a premium subscriber. Visit the website contrarian.supercast.tech. That's TECH for more information. Now, here's your host, Mr. Nathaniel E. Baker.
Chad Olivier of the Olivier Group, which I believe is down in Louisiana. Is that right?
It sure is. Baton Rouge, Louisiana.
Baton Rouge, Louisiana. So the French surname is maybe a bit of a giveaway there. Well, anyway, thank you so much for joining the Contrarian Investor Podcast today.
Yep, I appreciate it, Nathan.
Yeah, it's great to have you. And we're going to start talking about the bond market. And this is something that has, as you know, as our listeners know, has gone absolutely nowhere in years. Certainly since the Fed started raising rates, but even before, once with the COVID kind of got sorted out, the first stage there, stocks started rallying and bonds started sinking. And that's kind of been the story ever since. They have recovered a little bit this year on the prospect of higher interest rates. Of lower interest rates. But you are bullish on bonds. Tell me why.
I am. And it's just like most of the investment world, I've kind of gone away from bonds these past couple of years. And we went very, very strong growth. And even my more conservative portfolios, if you looked back a year ago, we were heavier in the stock sector up until, even 75, 80% equities, versus the bond market. But I've been doing this since 1996, and I've been through, especially when the Fed starts putting their hand into things, and you realistically, you can see what happens to certain markets when they start aggressively doing things on the way up and on the way down. So we feel that it's time for the bond market to start to really participate. And as the Fed starts to lower interest rates, then you'll get some dividend yield. But most of all, especially if you're on the long side of the curve, you're going to get some double-digit returns in the bond market, which we haven't seen in years now.
Yeah. And so how long are we talking here alongside of the curve? Like 30 years? Like, yeah.
Yeah. So we're going to we started after the first quarter, started to add a little bit more bond exposure. And we did it with ETFs. Again, we're an active management firm, so we have managers that are managing ETF portfolios, stock portfolios, and individual bond portfolios. But where we believe we're going to get the biggest bang of our buck is going to be those ETF portfolios. So we started introducing on the long side of the curve some ETF strategies. Our intention is in this third quarter that we'll start add more to that world to try to get it almost at its I would say at a good point in the marketplace, where we do believe that the fourth quarter they'll start to lower interest rates, and then he's going to have to do it a little bit aggressively next year.
Okay, yeah. So that's another thing that I want to talk about. So when you're saying the ETFs, nothing we say is investment advice, but there is an ETF, the TLT, the iShares 20 plus year Treasury bond ETF, which I'm assuming might be an example of what you're talking about.
It is. Yep. And they got, there's many out there, but,
sure.
Thinking of the 20, 25, 30 years out is probably going to be the sweet spot.
Okay. So let's take the 10 year as a gauge. What, 4.1 now, which is, by the way, quite a bit lower than it has been. Yields move inversely to prices. How low do you see this thing going?
Yeah, so we expected it to get into that 3% range
really?
By by say this time next year
Uh-huh.
is what we expect, and we do need to see the economy slow down some. We had that GDP hit last week at about
Right.
2.8%, higher than expected. But Powell's kind of put it out there that he's expecting that to kind of start to simmer down and spending to start to go down. And so we're expecting that he's going to have to step in a little bit more aggressive than most people believe.
Interesting. And so you don't think it's just going to be a one and done rate cut in September?
No, I think he's gonna start that series of cuts. I always remember back to the Greenspan days.
Mm,
In Greenspan, when he did those when he raised the rates. I mean I remember the 1.25% raise
yeah.
up, and then when he got to the point where he believed that that was enough, he went aggressive on the
Mm,
way down also. And so I
mhm.
believe it's gonna be about the same. He's gonna have to put a hand in that and really get aggressive with it.
Interesting. Now, the last time that's happened, in 2020, the reason they did that was because the economy stopped literally overnight due to COVID. And so they had to cut interest rates to zero. And it was hard to argue against that from a policy standpoint. But wouldn't you need kind of a similar slowdown in the economy? Maybe not a complete stop like we saw, but certainly a pretty big drop off of the growth that we've seen.
Uh, yes, yes. So we don't believe there's going to be a COVID type event that's going to
Mhm.
happen, but
If you did
um,
know that and you're holding it from us, then please do. But no, go ahead.
yeah, right, exactly. Yeah, yeah. But all that being said, he's indicating that there's slowing that's happening. And when it happens, it tends to be more of like a snowball effect that it's not going to just be a little bit like it's going to realistically start, and then you'll start to get the layoffs. Then you'll start to get, it's just kind of a compounding effect. And he mentioned the last meeting that he needs to kind of look at it two-pronged, where he is fighting inflation, doesn't want to ruin what they've done so far, but he does realize when you look back in history that if the Fed is so aggressive on one side that they will bring this thing to a halt, and it could hurt for a longer period of time if they don't
Mm,
act on it. Yeah. So.
mhm. Yeah. So yeah, wow. So then bonds would certainly be the place to go if there is that kind of risk off type of move. But what do you say of the argument that the economy is so different now that it and that there is so much growth that it will take time to slow, and there's so much momentum, and that even then bonds they won't be able to cut to zero because of inflationary pressures, and other
Sure.
things.
Yeah, so we do not believe that it's gonna be a zero, or we don't believe that you're gonna
Okay.
go out and get those 2% mortgages anymore. I mean,
Right.
I believe it's gonna get to like a more of a reasonable level. Again, if we get the 10-year in that 3% range, which is it's a healthy 10-year, we still have growth. But from this level, from the 4.1, 4.2 to the 3, or if again you look at the long bond at 4.25, 4.5 to 3.5, 3.25, that's double-digit returns on a bond market. And so that's again, you can take some risk off the portfolios and get that. Now we are very bullish on stocks. We're not saying we're not bullish on stocks, but there's just opportunities there in this sector. I know the big buzz right now is the small cap sector. Small caps have done incredible the past 3 weeks. I believe they're up over 10%. And when we're watching other sectors get beat down, especially technology sector, and you got the small cap sector going up. I guess I'm not worried about the small caps, but I'm not so bullish on the small cap sector. And the reason why is if we do have this slowdown, then the small caps will get beat up. I think money's moving to it right now just because it's got a place to go. and that seems where it's going right now. But as far as the long term, we're not very, very bullish on the small cap sector.
Thing. Wouldn't lower rates help small caps though? Lower the cost of borrowing, et cetera?
It will, but on the other side of it, if they're lowering rates aggressively, then we're going into a recession. Recession will not help that sector of it. It's almost the same idea if you're looking at the bond market and you look at those high yield bonds, which back in my day they used to call it junk bonds, but high yield bonds. As interest rates come down, like you should be able to get the most bang for your buck in that sector, but if it's companies that are very dependent on debt, then you have to watch out as the economy slows down and you go into even a minor recession. A lot of those companies they're not geared to be in a recession for any period of time.
Yeah, yeah, really interesting. But you think tech is going to hold up okay?
I believe so.
Mhm.
What's amazing is just, I can remember back in the 90s, we were so excited about the tech sector and we are buying the .coms. This whole internet thing was really starting to boom. And you were buying companies you were investing in companies that just had so much debt and just the prospects of growth. And now I'm just amazed because many of these companies have zero debt, like zero debt. So they can do things that those other companies couldn't do. And one of them is, especially if we go through some type of a recession and a slowdown, these bigger tech companies can go out and just buy their technology for, I would say, pennies on a dollar.
Mm.
So we always stress with our clients, I hold many of these big names for 20 plus years. I've been holding them, and it's like this is when a recession happens or when things get a little shaky, like these companies will do really well after things settle a little bit, So they'll get beat up in the short term, but then they're going out and buying companies just with all this cash. Like we're waiting for things to happen so they can go get this technology and just buy it from these smaller companies.
So you mean they'd be buying up competitors?
Yeah, that's exactly it. Yeah.
Interesting. But yeah, because if you think through this whole scenario, like Nvidia, and to your point, like if people compare Nvidia to the .coms, like it's completely, I mean, Nvidia has what is their order? What is their backlog now, right? I mean, the .coms, forget about backlog. They didn't even have business plans barely, right? They only had the
That's
prospect
right.
of revenues, right? They even have
Yeah.
revenues. Like,
No.
and Nvidia is like the business is massive. But what is the business? Like it's companies buying these chips, right?
Right.
And if
Right.
there's a slowdown, wouldn't they slow down the chip buying too? And wouldn't that affect them? And then wouldn't that have a cascading effect?
It will. It will. But again, plenty of cash. So it's almost like if you're the best, any company, if you're the best in that area and you have cash, then it's just kind of like a wait and see, and then you end up bigger and better when things come back. And so I'm an optimistic guy that, I always believe that we will come back. And when you get hit, we just got to make sure clients don't freak out and try to go to cash, which we don't allow anybody to go to cash if they're with us. But that's our thought on it. And just I mean, I always kind of you look back, not even 2 years ago, and in that tech sector, you were buying big names for 60, 70% discounts. And I had one of the team members here just run an analysis of, 20 years on all, two of the big names out there, going back 20 years. And every time they had that 40 to 50% decline, it's like the next 3 years, it was triple digits. I
Mhm.
mean, that's what happens. I mean,
Yeah.
that's it. It's just good companies
Hmm.
that have cash. Yeah, I think
Sure.
cash is king with those companies. Yeah.
Yeah. And especially once you get a slowdown. And I guess in the interim, your clients, if they're holding bonds, they can clip those coupons and hopefully be quite happy as there is a slowdown.
Yeah, and I think, and again, we do have pure bond portfolios, but I believe where we're going to do really well is on the actual overall return of those accounts.
Mm.
And so those overall returns, we're not holding a bond to maturity. we more along the lines of in that market and working it with the ETF strategies. And so we believe like that's where you can do some good at this
Yeah.
point.
And this would just be govies as opposed to corporates or, yeah.
We go across the board. So we
Okay.
go
Okay.
across the board. It all depends. What tends to happen is certain markets will get beat up more than other markets, and so they're more attractive. And then we have the active managers. So with our active managers, we're basically letting them know we want to be in this range, and then they actively manage it. And so if they have to buy munis, if they have to go straight government, that's where they're going to go. We kind of leave it to them.
Yeah, I see. I see. Yeah, I was going to ask you about munis because that's another section that's gotten beaten up. But yeah, do you have any thoughts there, or do you think that could be a good one too?
No, that can be a very good one. And what's amazing with those munis is that if you look back at that sector, you just don't see a lot of failures happening. And so if you're in strong states, and it all depends upon for Louisiana, if if it's a GO bond, government obligation bond, then if the municipality gets in trouble, the government can come in and help it, the Louisiana. And
Mm,
so just need to know where you're getting, if you're getting individual bonds, or if you have an actual manager,
mm.
how they actually handling that. With each different state, there's different rules.
Yeah, of course. Any thoughts on closed end funds? That's a lot of one way to get exposure to munis is by these closed
Yeah,
end
it
funds.
is. We don't do a lot of it, but what's interesting with the closed-end funds, you can just like the ETF worlds, like there's value in the actual investment, and then there's value on the supply and demand side of it. So you can get deep discounts on things if the intrinsic value of the stuff's in there might be a certain value, and then you can get it might be 15% down just
Mm,
because people aren't buying it. That's the same thing with the ETF world too.
yeah, yeah, yeah. A lot of the munis trade at a discount
Hmm.
to their NAV. Unfortunately, they stay there a lot of them. And
Right.
then you get cashed out at the not at the NAV price, but at the some other price.
Yeah.
Unfortunately. Anyway, all right, cool. Chad, Olivier, this is a very interesting conversation. I want to come back and ask you some more about yourself, about your firm, the Olivier Group, and some other things. But let's first take a quick break. If you are a premium subscriber, you will not get the break. So don't touch the dial. We'll be right back. In fact, we already are. And everybody else who wants to become a premium subscriber, visit the website contrarianpod.substack.com and sign up.
We hope you're enjoying this episode of the Contrarian Investor Podcast, where we give voice to those who challenge a prevailing narrative in global financial markets. Consider becoming a premium subscriber. For $9 a month or less, premium subscribers receive a number of benefits. Podcasts are posted immediately after they're recorded. Transcripts are made available within 24 hours. Premium subscribers get direct access to the host, and of course, there are no ads or interruptions. Visit contrarian.supercast.tech for more information.
By the way, you don't need the .tech suffix to get to that website. .com will do the trick. And we also have a Substack where you can sign up for the same prices, same benefits, same details, contrarianpod.substack.com. So if you already have a Substack account and use it, or have the app and use that, that's probably the best way to go. So contrarian.supercast.com or contrarianpod.substack.com. Whole bunch of benefits, including, of course, getting this episode up to a week early without ads or annoying announcements. And you also get the daily Contrarian briefing and podcast that is released every market day morning at 7 a.m. This is a contrarian take on the events of the day ahead and what is likely to move markets, such as economic data releases, earnings, and other things. It is really good, and that is completely unbiased, of course. So check that out, contrarianpod.substack.com or contrarian.supercast.tech. Now on with the show. Welcome back, everybody. Chad Olivier, the Olivier Group out of Baton Rouge, Louisiana, which is where LSU is. We can talk about college football at some point. No, it's not this. It's not the place. But this is a segment of the show where I like to ask the guests about themselves and how they came to investing in the first place, their origin story, if you were. And so, yeah, tell us about it. Tell us how you got involved and how you came to start your own group and everything along the way.
Sure. So we are a financial planning firm here in Baton Rouge. We also have an office in New Orleans. I'm originally from New Orleans area. And we manage about just my firm here manages about 460 million in client assets, mostly with CEOs, doctors, dentists, and retirees. Kind of a little bit broad there with retirees. But I started in the business back in 1996, little bitty firm in New Orleans that about the only firm that would hire 22-year-olds. And so they hired us to study for the bond exam and then cold call little old ladies on tax-free bonds. So started off my career just with a Series 52, which is a test that usually bond traders have. And so from there, got the Series 7 and then moved from New Orleans to Baton Rouge. My wife got into law school here at LSU. And so in Baton Rouge for a few years and then started Olivier Group in 2002.
Oh, wow. So it's been that long. Yeah.
Yeah. So it's been a while. And I'm a certified financial planner, got a team here of 10 of us in the office. And of the 10, 3 of us are certified financial planners. And we mostly are a financial planning firm, manage clients' assets. I'm also a certified exit planner, which is I help business owners in the process of exiting their business or getting prepared for exit of their business and passing it on either to the next generation or selling it outright. So we got a couple arms to our business, but we tell clients that we handle anything with a dollar sign. So we're the point of contact, and we make sure your whole world is organized as far as tax planning, investment planning, insurance planning, estate planning, anything out there with a dollar sign, we can help you with.
Very cool. And how are most of your clients from Louisiana, from that area, or are they nationwide?
They're nationwide. So we got a number of them in Texas and Florida, but we do have we got a great presence here in Baton Rouge. I'm on the television here doing the news broadcast on Fox News and on NBC the next morning actually. So that and write for a number of publications. So, I mean, we got great presence in Baton Rouge, but we do have clients nationwide.
Mm-hmm. How is the economy in Louisiana? I'm curious. So, yeah.
Yeah, so it's right now it's very good. So we are a very oil-based economy. So as long as the oil market is doing well, we will tend to do well. Now when it starts to hurt and you see the barrel of oil below 50 and going down, that's when Louisiana really starts to hurt.
Yeah. Do you think that oil could be, I mean, it's now in the 70s. Could that be a good trade potentially? I mean, with the Fed lowering rates, right?
Right. No, it is and it will be, and especially some of the big companies that high dividends as they lower interest rates. I mean, you can grab some high dividend stocks in that oil sector that they, I mean, great earnings, great earnings, and so yeah. So I mean that's a sector that will come back into play. And we're seeing some shifts happen in the market right now. So I know the NASDAQ's getting really beat up at, this past week, but look where some of that money's starting to go, and it's starting to go into some of the higher dividend stocks where you're going to see that.
Yeah. I noticed pipeline stocks too. They've done,
Yep. So it's incredible. I had a client that he's been waiting for 4 years for this stock that basically went down to single digits, and we put a limit price order on it, and it's good to cancel. And all of a sudden, geez, we wouldn't think it was going to get close to it, and then
Wow.
yesterday it hit it. So it was like,
Wow.
hey, okay, yeah. So it was, if you 5 years ago we looked at it, it was I mean the value of it was, I mean, just terrible. And then all of a sudden it's come back to life, just like you said. Yeah.
Yeah. Yeah. And yeah, what other things are you watching here? Do you think there's anything that could change? People have cited, Trump as being, such a positive that maybe we'll get the soft landing right away type of thing, and other stuff. What other events are you watching for this year?
Sure. I think as far as the presidency, Trump and or Biden, we knew what we're going to get. Now we don't know exactly what we're going to get as Kamala came in with that. So that's got the market probably a little shaky with
Hmm.
that part if she gets momentum. But the presidency, really, we feel like that's not the big deciding factor. As Congress is more what if Congress can go a certain way, and say if it goes the Republican way, then something, and there's a Republican president, then all those tax cuts that happened that expire at the end of next year, with the estate tax and everything, that will go in a very good direction for high income earners and people that will have an estate problem. Uh, but if we got a Republican Congress and a Democratic president, then we probably gonna have a negotiation. So something's gonna happen. I think the probably the only negative in that whole situation is Democrat, because by the again, they'll let those tax cuts just expire. So you're gonna have a big tax increase at the end of that year. And if the economy's a little bit soft next year, that's not gonna
Yeah,
help out much at
interesting.
all. Yeah.
What are the chances of that happening now? Well, I guess it's an right now it's an even split, isn't it? Or is it 51-49 or something? Yeah.
Yeah, something like that. It's
Mm.
not we don't it's interesting. If you would ask me this question 2 weeks ago,
Yeah.
it looked a lot different than it does now.
Hmm.
So, and then as we get closer, it seems like everything just kind of comes to that middle ground again. It's whoever can get out the vote.
Sure.
And Nathaniel, I've always say this too. Like I'm like the worst gauge on telling you who's gonna win. Like I always think someone's gonna win and it's the other person, and I'm like, no,
Uh-huh.
this should win. And
Yeah.
so I've stepped away from that.
Okay.
And it almost to the point where I always laugh because they always say this is the most important election in history. I'm like every election they always say that. I mean, that's the like okay, yeah,
Yeah, I know. I
but
know.
yeah,
Yeah.
yeah.
Interesting. Yeah. So going back to financial planning here, like what kind of what are some common mistakes maybe that you see people make in that? Yeah.
Yeah, so for business owners, what I see very often is that the business owner is like living in the business, and like they associate the business with themselves, and so they run the business like it's their money, and it's all theirs. Even if you're 100% owner of the business is a total separate entity. So
Mm.
we are many times with businesses here that do extremely well. I'm just very surprised when they meeting with us and we're taking a look at their whole world, and it's like, okay, how is this getting paid? What is that? And you kind of really dive into it, and it's like, okay, if you ever want to sell this business in the future, like the value that you're going to get for it is nowhere as close to what it should be.
Mm.
Like you need to kind of think of it as its own separate entity. So we always say, like for business owners, business is a separate entity. It's a living, breathing organism that needs to be separate from your world. And then you can be an employee of it, you can be a stockholder of it and get distributions, but it can't be you can't be like it's your second piggy bank.
Right.
So that's something very common. And then for many individuals, I think many times they're very just short I guess they look very short term at things.
Mm.
I had a client that, when interest rates started going up and all of a sudden you're getting money markets at 5%. And we came off of like not a great year in the markets, bond or stock market. And when I was meeting with him, he said, "Well, let's just go ahead. We've already made all this money over the years. Let's just go ahead and take it all and move it to short-term CDs and short-term, everything short-term." The problem thinking that way, and I explained it to him. I said, "It's if you think long-term money, if you think short-term, you're going to get caught." You're going to get caught in between. They're going to lower interest rates, and then you're not going to have anywheres to go. All the returns are going to have already happened in the markets that you should have been in. And, that's why you do need to be diversified, but you don't need to be making, with long-term money, very short-term decisions like that. And that's where
Mm.
many clients, get in trouble with that because they just see the again, 5%, 4.5%, and they say, "Oh, I can get this. I need to move all my money to that. Why not just do that?" Well, that's the reason. That's the short-term thinking.
And I guess that's why you don't let people keep whole cash in there, right?
Yeah, so I don't let them go to cash.
Okay.
So
Okay.
what happens is we kind of do everything with like almost like a bucket type strategy. So especially retirees, you got the first bucket that's very short term investments, and that's your cash because they're living off of that. Then you got bucket two, which is the 2 to 10 year, which is going to be more dividend related investments, kind of big names, either stocks or bonds. And then you got the last one, which is going to be all your technology and all the big high growth stuff, 10 plus years. So we usually work in between buckets and we try to explain it to clients like, because you're always going to have clients that are like, "Wow, it's starting to get bad. Let's go to cash." Like you just don't know when it's going to turn around, first of
Mhm.
all. And it's bad right now. But I mean, I always think back to 2009 where, it looked like it was the worst time ever. And you had that, one day, I believe in March, that just was the turnaround.
Yep.
And if you go back there, you can constantly see the negatives out there that just say like, this is not going to last. This is going to be, a bear market bounce and how it was. It didn't stop
Yeah.
running. Like you were in. And
Yeah.
you need to be in diversified, and you just don't. Yeah, you need to be in very good stuff in the
Mm.
account, is what I would say. Yeah.
Mm-hmm. So do you have any like the traditional asset allocate? Jack Bogle of Vanguard would say, take your age, subtract that. Wait, how did it go? Take your age, put that in bonds, subtract it from 100, and put the rest in cash. Right? Yeah.
Yeah,
Right.
yeah. So I really don't believe that's the way to go.
Okay.
Just if and again, we had retirees these past couple of years that were that were sitting. I mean, they're in their 70s, and we're sitting with 75-80% stocks. Because
Wow.
that's where you're gonna get the return. And if we didn't do that, then we wouldn't have got anywhere close to returns that we've gotten these past 2 years.
Hmm.
And then if you go with that same thought that if these people were 70% in their 70s, if they were 75% bonds, I mean they got hurt 2 years ago, double
Hmm.
digits, and they've never caught up again. Like they're going the last 2 years, and they went another negative return, and then it went another year of a barely squeaking out a positive return. And it just doesn't, you kind of take what the market gives you, and the market's not it wasn't giving you the bond that bond side of it.
Yeah.
So you
Yeah.
need to make
It's
sure
true.
that you need to make sure the clients are now again we always look at risk tolerance of clients and we explain this to them because I do have a handful of clients that I would just say like will just be CDs and
Really.
something that's very fixed. Yeah, it's but not that many of them, but I do.
Uh-huh.
But they're not worried about realistically like even living off of the money, and
Uh-huh.
it's going to be passed on, but they don't want to see it go up and down. So you'll have some of those,
Understood. Yeah.
but the majority of my clients are not like that. The majority of them are we're actually actively investing for them.
Yeah. Yeah. And they need to grow the nest egg, I guess, still.
Right,
So
right.
any thoughts on cryptos? Would you advise anybody getting into that for any reason?
I it's yeah, look, it's an interesting market. It's there's going to be survivors in that sector. We'll call it a market sector. It really is. And then there'll be some really bad ones that are just gonna go away. It's almost like the dot-com
Yeah.
era where you just, I know you remember pets.com, like
Oh yeah.
that was going to
Of
be
course.
something very big. And it was like, because they put dot com behind that name, so the same thing in that crypto market. To me, it's a very interesting market. I don't know enough about it, but there's going to be survivors in that.
Hmm.
Yeah.
Hmm.
And they got ETF portfolios on it now, so they're
Yeah, which for
legitimizing it. Yeah.
spot ETF as well, spot Bitcoin as well
Uh-huh.
as not even futures.
Yeah.
All right, cool.
Interesting.
But it's so yeah, so okay, so we got bonds, especially long term, and then growth stocks, which you still like. Any
Yeah.
particular are there any areas of growth that you like best? And we talked about AI chip names.
Yeah. So that AI world to me is so interesting, and I write for a number of publications, and I'm writing an article, and I'm like, oh, this doesn't sound quite how I want it to sound, and you tell AI to do it, and then all of a sudden they rewrite it for you, and you're like, oh no, that sounds nice. Like
Yeah.
I was like, it's not exactly, and then you hit again, like redo it again, and so it gives
Mm.
you, and I'm on the TV with the market segments. So I'll put a bunch of ideas together and tell AI to, hey, go ahead and I'm doing this for the television. I need a 3-minute segment, and they just and they do the whole entire thing, and it's just. It's amazing. That whole segment is, and I think just it's different areas. It's not just the writing areas
Right.
obviously, but I mean it's everything from the healthcare area to the technology. Any different, again, it's gonna help things. It's gonna speed things.
Yeah.
It's gonna help the economy.
Yeah.
I was watching Greece with my boys the other day, and Grease won. Yeah, they had a musical. Yeah, so it's with John Travolta, Olivia Newton-John, and they had one of the characters in it made the comment something like, "Well, I guess instead of going to beauty school, I can just be a phone operator." And I was
Oh
like,
yeah, right.
and I
That's
had to
right.
explain what a phone operator was to
Of
to
course.
my boys.
Yeah.
Yeah, right,
Yeah.
right. So I think AI will do the same thing to
Yeah.
certain segments that just the whole telecommunications, internet, that whole world has done to the phone operator.
Yeah.
It's
Yeah.
it's a different market, and it's
Yeah.
a different market, and our kids will have different jobs because of it.
Of
So I
course.
think it's going to change the world, just like technology always does.
Yeah.
But I am very, very pro bullish on still that technology sector, even though they've been beating it down somewhat here. But
Yeah.
that's
Yeah.
my main one.
All right. Well, that's a good way to close. Maybe in conclusion, you tell listeners how they can find out more about you, more about your firm, and whether you're on social media. And I'll put all that in the show notes as well.
Perfect, perfect. Yeah, best way to find us is going to our website at Olivier, Olivier group.com. And from that, you could see you have my books on there, all the articles. You can get to all my other social media from that. And if you want someone to contact you from our office, you can hit that also, for us to contact you. And yeah, so I mean, and then we are on all the other social medias, but I believe that's the best way to get us.
Cool. OlivierGroup.com. Check it out. Thank you so much to Chad for joining us. Thank you all for listening. We'll be back here again in the next week or two with our next guest. See you then. Bye.
Thank you for listening to the Contrarian Investor Podcast. We hope you enjoyed this episode. To subscribe to this podcast, simply open your favorite podcast software and search for Contrarian Investor. Follow us on social media by searching for Contrarian Investor on Twitter and Instagram. Send us your thoughts on feedback@contrarianpod.com. We look forward to speaking to you again next time.